and a view of really where we think 2019 is going to look like. Then the bulk of the presentation in the middle will be giving you a sense of what are the assets really capable of doing. So we'll take you through in tremendous detail the work that's been done on how the play fairways will work within the Cardium and the rest of the asset portfolio. And then we'll really wrap up on, if we think about the goals we've set for Obsidian, how does the portfolio we have actually match that and get you from here to several years of value creation for the company? Before I kind of talk about a little background, I want to make sure you guys have a sense, because during the day I'd like you to get a chance to know the officers. So if you have a chance on break or afterwards to talk to them, really recognize them quickly. I'm Dave French, President and CEO of the company. Dave Henry, Chief Financial Officer, will you stand? Andrew Swartz, Vice President, Business Development and Commercial. Aaron Smith, Vice President of Development. And then Mark Hodgson, Vice President Operations and E&P Services. Before I get into the quarter, I want to give a little bit of thoughts of perhaps even the last 18 months. I think, as you probably know, and certainly the folks on the call who are listening in, the last 18 months as an owner of Obsidian has had some real challenges. And I think if I would look at it at what's happened with the stock and the performance of the business, it's really been tied to 3 moments in time and decisions that have affected the way the stock has performed over the last year, but don't really play into setting the context for what's going to happen in 2019 and beyond. And I would put it in sort of 3 buckets, and that's hedging, optimism, and a rush to big, not quick. As you guys know, in 2017, we put on a hedge book that was largely WTI related, because we sat in a meeting just like today, and WTI was trading at $45, and it was as likely to go to a 3 versus a 5. And so we took hedges, and we looked at our portfolio and said, we need $50 hedges in order to be able to do development in Viking, Peace River, and Cardium. So we layered on a hedge book about $50. You guys know the story, what happened the rest of the year. WTI ultimately ended up ran, and so our hedge book has been out of the money for most of this year. Oddly enough, the mark-to-market's quite a bit smaller in the last period of time, but that really did clip the upside of the stock for the first part of this year. Second thing was optimism. We actually rushed back and got back into development into the Viking, into prop in the latter part of 2017, and we drilled what looked like high watermark wells. Now, not water in a bad way, in terms of some of the best wells that have been drilled in the field. We poured all our optimism, set our expectations on those wells rolling into 2018, and unfortunately, they resolved to the mean. So we had very high forecasts coming into the year on a month's forecasts, set expectations off that, and unfortunately, they came back to normal rates. So that set us up for a first and second quarter, which were pretty tough. Third thing is, we rushed to big, not fast. So when we looked at our Cardium portfolio, which we have sort of 40-odd operated and non-operated, and Aaron will talk to the 33 operated waterflood businesses, we rushed to the hearts of those assets in order to look at big potential resource and redevelop brownfield waterflood developments. What you're going to see over the last 6 months, and it has been tremendous work of the team, is to think about, when you look at competitive activity, you look about where our asset portfolio really can be not necessarily big, but fast and crisp and develop in a pace and scale that's fantastic. It's playing the outside in. We started in the middle, and unfortunately that put us with higher water cuts than we expected and development that didn't generate cash fast enough. So when you stack that with hedge portfolio, early optimism, and rushing to the middle, the third quarter results are kind of not where we want it to be. Set the context for where we're headed now. It's going to go to the outside of our assets, going to drill very fast, very primary development focused, very fast cash, some of the best wells we think in the portfolio, and frankly within our peer group, sets a totally different context where the company's going. So highlights for the third quarter, to give you a little sense of where we were. Generally a soft quarter, short on volumes, but again set in the context of also a pretty difficult move in commodities. So we'll talk a lot about that throughout the presentation. Full year 2018 production is slightly below guidance. We revised down, largely due in many ways to the H1 Pembina program, which is again in the heart of our water flooding. And so now you'll see us redirect and very methodically develop the primary side of the Cardium. We expect about 37 BOEs per day wedge from the 15 Williston Green wells available for early 2019. 75% are already drilled. And near-term cash margin assessments, we are making conscious decisions. There's no way to ignore, and you guys, looking at your phones, thinking about where you are, everyone is watching. Every day feels different as to WTI and diffs. It has been one of the most volatile last 4 to 6 weeks of my career, watching pricing and thinking about how you want to steer in that world. So we have made some conscious choices. We're going to delay. We have fantastic, these 4 wells drilled in Peace River are fantastic. Right now we're not going to bring them on because we don't think it's effective as it relates to the netbacks in those Peace River. I think that's consistent with our peers as well around thinking about that business. We are actually, and have been over the last really 8 months, looking at what's the best strategy associated with our legacy assets. And there's a lot of gas in this portfolio, lots of individual wells. It costs us about $10 million a year to run it. We've looked at what's the right technical resource to sell it. Is there upside for us to develop? We ran both those assets and said not a lot of people want to buy a disaggregated portfolio that's losing money and just got abandonment liability. How do you deal with it as a company? So we're going through the process, and now we have the advantage of, and I don't want to preview too much of Mark's work, we have the advantage of a very methodical way to manage that asset that reduces our costs both on a net operating income standpoint and a capital standpoint. So we're going to go ahead and move to that business, which we think will shed sort of $7 to $10 million of cash out of the business that we can focus on the rest of the portfolio this year. Last but not least, we are actively looking at our H2 2018 Cardium program. I don't want to preview too much of Aaron's world, but essentially we are looking for adding barrels in our portfolio that are $20 netback business. Even in the current strip pricing, these Cardium Williston Green barrels, because our operating costs are so low, are fantastic. And so we are essentially in a swapping exercise of trying to get out the worst part of our portfolio and regularly aggregating and building a portfolio of high-margin light oil. It's a simple swapping exercise. And so that is the effort of the business. So when you look at our choices, we still believe continuing forward right now, but we are actively monitoring whether it makes sense to drill. And right now, the forward economics tell us, because it's all about first quarter of next year, wells drilled now, the money's made in the next 2 quarters. It's all about what that cash is. On current strip, we believe it's the right thing to do. Last but not least, we do expect Q4 to be constrained, but anticipate modest recovery in late Q1, Q2 on light differentials, and that's the reason why we do see a benefit in continuing with the drilling where we are. But I will tell you that's very important that we're watching it daily. As it relates to what you're going to see in the rest of the portfolio, the rest of the conversation today, you're going to see a series of conversations around what do we think of price, and I will tell you, I'm not sure how many times we've done this page because we've moved it probably 10 times over the last 3 weeks, because everyone can pick your own price. So you'll see 2 assumptions. 2019 plan is poured on a WTI of about $62 in US dollar per barrel, running about $19 on EdPar differential, ACO $1.75, and exchange about 1.3. We are going to show you an upside case because we believe there's some benefit in talking about if there is recovery and there's lots of volatility. We'll show you a $65 case on WTI with about $10 diffs and about $2 ACO. And so you'll see that choice in the second half of the year. The first half of the year is going to be poured based on what we believe a pretty modest, disciplined approach with the view that second half of the year we've got lots of toggleability. We did have a couple of calls that came in subsequent to Q3, so I thought I would talk a little bit about them, and I'm sure there's questions that will come in throughout our presentation and then online. But a couple of topics of interest: impact of WTI and diffs on the business. For every sort of US dollar Edmonton power reduction, that's about $7 million a year of funds flow. We expect Q4 funds flow will decrease. Obviously, Q3 was about $26 million. We're expecting kind of single digits for funds flow for Q4 with recovery heading into next year. As I talked about with the spend profile, each one of these Cardium wells is sort of $3 million and change, and you are dedicating ourselves to about $2 million at a piece. So we can toggle that up and down very easy. There's no commitments on the contracts. So our ability to manage cash is quite simple. It's quite straightforward. Hedging strategy. With previous backwardation, we didn't elect additional hedges in H2 2019. I would say right now the mark-to-market for that hedge book is getting close to zero. So our ability to cash them out or decide if we want to carry it is important. Frankly, it moves in and out of whether we actually want to keep it for next year. So that decision has been very different for us, but I just want to make this group understand that certainly for us, it isn't much of an overhang for the business, and the board's going to look at it over the coming weeks. We do expect Q3. We do ultimately believe taking some risk mitigation in the second half of next year and the first half of 2020 makes sense. So you'll probably see us come back out in Q1 with a modest, smaller in quantum and shorter in duration, because our program had typically been 50 to 60%. We had a little bit higher, 50% liquids running 6 quarters. I expect that'll be closer to a year and closer to 20-25%. And last but not least, both Prop and Viking, you will see in our plan, and all the pages you'll see after this, there's no ongoing development in Viking and Prop. We're actively looking at commercialization strategies for those assets, and so you won't see capital. We are actively swapping to that light barrel. So every dollar we spend, or the dollars are going to be focused on the best netback barrel we have in our portfolio, which isn't going to be focused on Viking or prop. And with that, Aaron, you want to give a quick update?
Good morning, everyone. Thank you, Dave. So it's my pleasure to give you a quick overview of how we progressed through our H2 program into the Cardium. It's a very easy job for me to have today because the results have been very, very positive for us. You'll recall that we had 7 wells drilled in early 2018 into the Willie Green Cardium, highlighted in these purple shades here. And you've no doubt heard how excited we are in terms of the rates, the capital performance, and so on. And it's my pleasure to say that we've been able to extend those successes into this H2 program, which is 15 wells. We've got 11 of them drilled, 5 of them fracked, and I'll walk you through some of the results today. You can see we're very excited about the deliverability wedge that we expect out of this program. 3,700 BOEs a day peak capability out of that program. Notably, 2,700 of those are oil. I think that oil weightedness of our program is something that really sets us apart. You can see that wedge there. A bit of an update on each of the pads for those that are interested there. We're actually fracking as we sit here today on the 4-6 pad, a 3-well. These are 4,900 and 5,000 meter wells. They are proceeding per textbook, so just very, very excited about that. This is an example that I've been using internally and externally to highlight the strengths of the program, the strengths of the technical team, and the strengths of our operational team in the field. So this is a drone photo, and I'm really enjoying these drone photos as they come in from the field because it's easy to get desensitized, I think, to the magnitude and the complexity of this work. But the logistics that the team have been able to put together here are just phenomenal. What you see here, and I've tried to annotate it a bit for you, is really 3 activities going on at one time on a reasonably sized pad here, and I'll explain why that's significant in a moment. We've got a frac stimulation going on one of the 3 wells on this pad. We're actually flowing back to testers, a second well on the pad, and the 3rd well had a bit of a screen out on the first few stages, and so we've got a coiled tubing unit addressing the 3rd. And so what looks very busy here, there's actually a very good cost-saving story here because frac crews are very expensive. And I think this photo does a very good job of showing that just through the sheer number of vehicles and staff that are on location to conduct these operations. Keeping them busy 24/7, literally in this case, is a real boon to managing your costs because any interruption you have on one well can really then be mitigated by moving on to another well on that pad very quickly, and that's exactly what we did here. The last element to show you on the slide is, and I'll speak to cost savings in a moment, but just the very wet, cool conditions that we suffered in Q3 of this year, particularly in late September and early October, to be able to deliver on the capital performance that we've done and maintain and actually exceed the schedule that we've put forth, I think is no small feat in these conditions. So you haven't heard us come back and say the wet weather has delayed us. We've been able to stick to our schedule and actually beat it and beat our costs as well. Of course, you want good costs, but deliverability is very important as well. And I don't have IP60 numbers for you, so what I would do instead is give you IP60 hour rates. So I'm being flipped a little bit, but these are post-frac flowback results from the wells. In this case, that same 8 to 9 pad, a 3-well pad. And what I've done with the dotted lines in behind is conveyed the 5 wells and how they reacted in that same window of time earlier this year. With the inference being that if the wells are behaving similarly in terms of pressure, oil deliverability, and their willingness to flow to surface, I expect that those wells are going to perform very, very similarly over the next 6 months. And I think you can see here that on average for the new wells shown in the green lines, we're very, very excited. In particular, one of the wells, 16 of 15, is doing very well for us. No sooner than I had finished the slide, the team had said, hey, we've actually got these wells flowing up tubing and into our infrastructure. So we've added to this slide now the initial deliverability, and each of the wells is flowing at 600 BOEs or greater. At this point in the type curve, they're 85 to 90% oil, so phenomenal rates for us. And they're actually inclining, so we're bringing these wells on in a responsible way, trying to make sure that we're not bringing sand into the wellbore and making sure that everything is warm in the infrastructure to bring it to market. So very, very good results. I think we're going to be quite pleased how these wells perform over the next several months. On the bottom of the slide, I put it in small font here, but I really do want to stress the capital performance. On the drilling side, I'll show you a slide later this morning around the days that we're using to drill these wells is coming down all the time. In terms of a total well cost, they're actually 4 to 6% below the internal economic estimates that we've been using. A big portion of that savings is just this sheer efficiency. Our rate of penetrations are significantly higher than they've been in the past. On the completion side, likewise, 5% or even more. Really a credit to the completion system that we've got in the well, the synergies of being able to add these extra stages essentially free. This, of course, they're not free. And shrewd negotiating on our operating team as well. We've been able to keep those completions costs quite a bit lower than I was expecting at the time of AFEing these wells. Similarly, on the theme of operational efficiency, while we're completing these wells, we've got pipelines going in onto the field, and we simply need about a 2-week window to button up these wells and get these volumes into our infrastructure and off to sales. And so that work is occurring right now, and we'll be starting up the second pad here next week, I believe. Speaking of that second pad, here's the 14 of 1. This activity mirrors and actually sits on the very same pad site as one of the ones from the early 2018 program. So these wells don't have construction costs in them, as you can imagine. And so again, a very similar plot here showing the dotted line from earlier 2018 wells, the solid lines for the recent results. Very, very pleased with what we're seeing here. Likewise, on the previous pad, high oil contents to these, and these are actually oil rates that are shown on these plots. The shrewd eyes in the room will notice that the vertical axis here is not quite as high as on the previous slide. These are attacking or exploiting different areas of the reservoir, and what I would point out is this well here, this dotted guy is the 02-16-06. When you look at the public data on that well, it was the strongest oil producer out of all 7 of the wells in that 3 to 6 month time frame, or 3 to 6 months after the wells were brought on. So that vertical axis here isn't the full story, but it does suggest that these recent wells have been very much in line with the 7 wells that we put into the plate earlier this year. With that, I'll hand it over to Mark.
Good morning. Can you hear me? Okay, I just want to spend a few minutes talking about ARO. It's a topic that comes up from time to time. Give you an update on how we're thinking about ARO, but also give you a little bit more color on the decision to shut in the legacy portfolio announced with the Q3 results. As you can see here, Obsidian's historical ARO has been in steady decline over the last 5 years, partially due to divestment of viability, but also due to a step change in abandonment costs. Positive trends, no doubt, but one of the things that we've been working with the AER and a few other industry participants on over the past couple of years actually is something called area-based closure. The area-based closure program being rolled out this year to broader industry by the AER is a program designed to allow industry to move away from random abandonment efforts scattered across the province and in its place commit to a cap spend multi-year closure plan. The new framework allows industry to capitalize on efficiencies of mobilization, economies of scale when it comes to equipment, multi-company area efforts, and efficient project management. So what does that mean for Obsidian? What you can expect to see from us over the next few years is a dedicated program of legacy field abandonment over the next 12 years that will see us cut over 35% of our ARO estimate and abandon 23 legacy fields. Sorry, just getting a drink. The pace of this will be dictated by the ABC liability model, which is set by the AER, which is currently 4% of inactive liability. For Obsidian, that translates into roughly 2 to 3 legacy fields that will be abandoned per year over the 12-year program. You can see here as well, we've just tried to illustrate some of the savings when it comes to well abandonment costs, average pipeline abandonment costs. They've been steadily decreasing due to shifting industry practices, but what you can see here is a step change when it comes to the ABC implementation, and that's really because you're going to a field-based effort rather than scattered efforts across the province. So it's really that economies of scale that you can realize. Translating that into 2019, this was really a no-brainer decision for us. Now that we have a clear path forward in terms of managing the liability of the abandonment over the next decade, what we see in terms of improvements on NOI, operating cost netbacks, liquids ratios, and predominantly the savings that you can see in terms of the actual spend yields an incremental value to the business that wouldn't have been able to be achieved without the ABC program in place. So at the end of the day, what I really wanted to leave you with here is, yes, we're shutting in 1,300 BOE per day of gas, but what it net gives to the business is about $7 to $10 million that we can spend on incremental development within current funds flow. Thanks. Back to you, Aaron.
Thanks, Mark. As everyone knows, the last 6 weeks or so have been an extraordinary time in terms of the volatility related to oil prices, both on a WTI basis and into the Alberta domestic market. What we wanted to do is bring some clarity to you around some of our decision-making processes around this Williston Green program and how we approach things like producing the wells that we've been drilled and how that impacts our go-forward decisions to continue with the program. What you need to know about Williston Green is that the operating expenses in that asset are some of the lowest that I've seen in an oil asset, period, in my 20 years in industry. In aggregate, on a total basis, we're around that $8 per BOE level, which is a phenomenal OPEX number, and that is really impacting our decisions. It's giving us a lot of latitude. What also gives us a lot of latitude is the sheer strength of these new wells. As I've shown you on some of the previous slides, the high deliverability from these wells and that significant revenue wedge really gives us some latitude to make good decisions. And as I mentioned, we've got about 4 wells left in this program and then a planned 7-well Cardium program into Q1 that was discussed in the press release this morning. What I've tried to do in the chart below here is convey some of our view of producing netbacks at the different ED/PAR prices shown on bottom in a US dollar basis to make it a little bit easier to scale your own thoughts should WTI change or the differentials change. For context here, the green bar reflects the type curve economic pricing assumptions just to make it easy for you to walk yourself up and down that curve based on your perspective on how the world works. But what I want you to notice is that even at the far left end or the dire end of this chart, the producing netbacks of these new wells is still significantly positive, above that $20 a BOE level. So on that basis, we're really presented with compelling go-forward economics for the wells that are already put into the program. Now that said, for the wells that remain in the program, I think what I want to leave you with is a sense that we treat every dollar as very important. And so we have the ability to make well-specific decisions as we go through the program. And remember, wells drilled today are really looking at the end of Q1 in terms of the pricing that they're going to first encounter. So we're really not only watching the current environment, but what's happening 3 to 6 months out and making sure that as we bring these wells on, we're giving them the best chance possible to materially add to our portfolio. So again, it's a well-by-well perspective on the decision-making. And we really have no long-term commitments at all with respect to the drilling rigs or the frac crews. So we do fully have control as to the pace of the program and when it occurs.
Okay, so before we go to questions, I'll just give you a quick overview of what was released today, and that's the 2019 outlook for the plan. We're pouring what we consider to be a conservative, kind of balance sheet-oriented development program, as you saw in the press release, with optionality in the second half, and you'll see that optionality described in detail throughout the presentation. In view of differential outlook, though, we have decided to only pour the first half at $65 million and give a view as the second half, which we will range between $55 and $95 million, depending upon second half pricing. We anticipate delivering a self-funded Cardium-like growth, and on that basis of the $65 million and the $55 million, roughly a 3.3 to 6% growth profile on the entire portfolio. We do believe, though, that the Cardium itself will grow closer to 10%. So when you're looking at that business, and we'll talk about the evolution of cash within that business, even though the broader portfolio is 3 to 6, we're swapping out light barrels for the rest of the portfolio on a very methodical basis, even at $120 million capital. Williston Green will be the cornerstone, and we'll follow up on 2018 results. And this is really focused on a tremendous effort of the team to prepare for and be ready to have what I would consider, and we have done development campaigns in the Cardium before, but this is the deepest and most focused on outside-in primary development Cardium in the history of the company. If you look at what that means portfolio-wise, though, we're focused on drilling the wells on this page. So when you look at what's the average of the rates between a 2,200 meter and a 2,600 meter go between sort of 400 and 500 barrel a day IPs, but even out 3 months, they're 200 and 250 barrels each. And that only matters if we're making money with the wells. So what we tried to construct on the right-hand side is a view of a $55 US Ed Par, which is what you saw Aaron talk about, and then take it down to a $40 Ed Par. On realized price, obviously that clips about $14 off the realized price. The transportation, royalties, incremental operating costs, look at these numbers. These numbers range between $4 and $6, so you still end up with netbacks in the $30 range. Even with an Ed Par that you're seeing on today's strip, you would still see that $20 cash margins as to the assets, which is all about, again, not big, but quick. We're focusing on assets that actually have fast cash cycles, and this is in this portfolio, we believe it is very warranted because the build of swapping out to these barrels is the evolution of Obsidian. So what that means for the budget is going to report a $65 million first half of the year. $52 million of that is development. That breaks out roughly $30 million pure as to the Cardium. We do have 2 deep basin wells, and you'll see that described later today. Those are the only non-Cardium assets in the portfolio for next year to be drilled. And then some other, we still believe some portion of optimization, and we have a couple of non-op expectations as well. But the development plan is very disciplined and sort of matched to how we think the evolution of cash. When you look at 2019 capital and well count optionality, obviously this is a flavor of 2 halves of the year. First half of the year is $65 million, and then about $55 million second half with another optionality to run to $95. You'll notice in the portfolio on the right-hand side under well counts, roughly 9 wells in the first half. 2 of those wells are deep basin, and we'll describe the technical reasons for doing so. And then the second half of the year is all Cardium. The nice thing about the first half of the year is it's fully licensed. And I would say, and not very far away, we'll have all of H2 ready to go because they're currently acquiring surface rights. We have optionality for a very deep inventory. Turning to H2, very similar breakdown. You saw roughly $40 million in 15 in terms of corporate capital with $40 million of optionality. That breaks out with very similar ratios. Roughly 75% of that is pure Cardium, and then a similar use of optimization and non-op drilling. What that means for guidance for the year, which was released this morning as well, is we're looking between 28 and 29,000 barrels a day of production for full year 2019. That's a 3 to 6% growth and puts us in operating costs around $13 to $13.50, and our G&A will sit right around $2, so $1.75 to $2.25. Obviously, if we expand the development in the second half of the year, that'll put another 1,000 barrels a day on the average of 4Q, which will put another 2 points of growth on the low and high end spectrum. For us, it's going to be all about measured development and choosing how many of these wells to develop as we carefully decide rig moves. But we believe this is a very disciplined plan heading into next year. And with that, I think I would open questions. I'd invite Aaron and Mark to come up, and even Dave. Are there any questions either in the room or online? Okay. In the room first. Sure. You got the mic.
Just wondering on your Cardium program, like how do you strike the balance of drilling within the unit versus drilling outside of the unit? Because it just seems like, you know, your first pad was within the unit, great rates, and then the balance of the year is outside, and then I didn't notice a breakdown for the second half. So, and the Cardium option as well. Where will those wells be?
You bet. So great question.
You've got the question online.
Yeah, so thank you for your question. That's a great question. The unit and non-unit lands historically have meant waterflood and primary development. What's unique about Crimson is on the eastern flank of that unitized land is really a swath or a bank of resource that has not been swept by the waterflood at all. So it's really best to think of that as a pressure-supported primary development. And that's why you see this orderly step out of the wells essentially a sequenced order of operations. As we get into some of the other assets, and I'll walk you through the development plans that we have for all of them, you'll see a few examples where it's a little bit more fairway-based within a waterflood. So I think the best way to think of Crimson is very much a primary development that just happens to be immediately neighboring a waterflood and attacking a very wide and productive banked oil fairway.
Almost think of it as we're going to play the no-flow boundaries of the water flood. So where you had injection to one side but no production on the other side, we're going to tuck up into that no-flow boundary. So it's in the water flood, but it's taking advantage of previous work, but primary driven. Any other questions, please?
David, on the Viking and prop, you said evaluation of sale and alternative commercial arrangements. Could you give us a sense of what that latter statement may mean in terms of bookends?
Yeah, alternative commercial arrangements means when you look at both those assets, it's healthy to think about some reinvestment profile in them because you want to maintain the heart of the asset. We're certainly looking at opportunities to especially in Viking, we have a widespread 50-mile wide, 25-mile north-south acreage position that goes into 3 different facilities. We do think it may not look at one person would be the right person to own that asset, but it may be several parties who farming in next to their acreage is a natural evolution. So that commercialization would look at other ways to identify probably not one answer, but multiple answers to find commercial value to get barrels out of the property. So all we're doing is looking at different ways to bring forward the barrels in the ground, because in our mind it's not going to compete directly with the Cardium assets which we're developing. So we want to find a way to resource it, but we're going to do it probably with other people's money and probably not one size fits all. Yes.
Yeah, thanks. So Dave, in your opening remarks, you said that, going into the second half of the year, some of the wells didn't perform like you expected. So my question is, what kind of conservatism have you baked into 2019?
So you'll notice that there's been a lot of effort and Aaron was trying to give you a sense of tagging the early days results with historical performance of the first half. So when we walk along the western side and the eastern side of the North Saskatchewan River in Williston Green, we've really focused on how do we match what actually happened over history rather than, even though we've got early days results, we've asked conservatism and let's set type curves. So that whole view of the 3,000 to 3,700 BOE, of which 3,000 and change is barrels, are tied to the average performance of that curve. So we've reverted to the mean of the performance where we can establish that we have a pure analog. So there's a lot of effort of the technical team to lay into the average, to set to the mean, and to be sure that we're not too early days in terms of assuming what they would look like. I think we have a lot of confidence around the delivery, and the team has done tremendous work to make sure that we're really thinking about averaging and setting expectations that are very deliverable. For us, it's focusing on de-risking the play.
As a follow-on, what kind of decline assumptions are you using for next year?
Yeah.
So I'll defer the specifics perhaps to Danny. Do you want to speak to the...
So JJ, are you asking corporately or as it relates to the Cardium?
Oh, I'm sorry.
Corporately, I would say the corporate decline for the company is around 19%. And I think as we drill forward with a primary-driven program, that number will walk into the mid-20s. That's just because the nature of the new wells coming on at much steeper declines.
Hypothetically, if you were to sell Viking and prop, what would that leave your Cardium in terms of decline rate?
So the underlying Cardium, the base waterflood part of the Cardium is probably 18%, 15 to 18% decline. Obviously, as we add individual primary wells, you're stacking on. I think if you look at the play forward, and you'll see it later in the presentation, I think you could imagine a business that would walk itself into the 30s. We have a corporate objective that we want to be a top tier as it relates to decline. So I can imagine a walking 20 to high 20s, even probably pushing 30% if we were pure development while we're maintaining this, frankly, very advantaged shallow decline asset that sits in the core. Are there any other questions on that? Anything else in the room?
Okay.
Just a couple from the webcast portal. First one's a little bit more generic. We did mention something in the quarter about relaxation of the covenants with our senior note holders, so a couple folks are just asking to expand on that a little bit and comment on the strength of our balance sheet right now.
Dave, you want to take it?
Sure, I will.
Good morning, everyone. So with Canadian oil taking downward, let's call it reduction over the last few weeks or last couple of months, when we're looking at the company, we look at leverage, but we also look at debt to EBITDA going forward. And so in order to provide the flexibility to continue our capital program, it became prudent to work with a very constructive debt group that we've got right now. And so we decided to put that added debt relief going forward. So we're very comfortable with our capital structure and the flexibility that we've got going forward.
Okay, and the next one was, obviously we had an NYSE listing notice a couple months ago. What are the remedy plans for that?
Yeah, so I'll take that. I think obviously we have several months to make a decision on this. It is one of those things where you want to think about it as you get close. We obviously have an obligation before our AGM to make a decision on whether there's only a couple things you could do here. You could, if we got into a situation where there was potential for the delisting, we could allow that delisting to occur, or we more than likely, and I would say we would weigh the option of a share consolidation. Between those two choices, the board would evaluate that over the next quarter. I expect we'll probably look at them quite seriously and consider what we think is in the best interest for the shareholders. It does cost us a little bit to maintain that New York listing, but we also believe we have a number of shareholders in the U.S., so we want to honor and protect their ability to trade. So that trade-off of liquidity for south of the border trading, as well as just the cost of delisting, is something we'd have to decide as we get closer.
And I'd say just the final one before we move on would be comment around share buybacks. You've seen a lot of our peers do that, maybe not in actual material amounts, but can you comment on that?
I would say so on a share buy basis, and obviously if you look at the forward economics of individually drilling wells or a share buyback at the current share price, I would say that both of those are in the money in terms of a logical consequence of use of capital. We do have with us restrictions as it relates to our operating costs with both the RBL and the senior debt to use normal operating cash for share buybacks. There's restrictions on that. But to the extent we had proceeds from transactions or other uses of funds, I think we would look very hard at a combination of development with those proceeds and some combination of share backs. I think the board understands that it's time in the world where the price is today. We want to do something that is accretive to the shareholders. We think the development of light Cardium and swapping our portfolio is there, but I think we would certainly look at some combination of those based on proceeds, not related to use of operating costs. So with that, I'll come back to where do we think about where we're heading as a company. And just to give you a sense of everything you're going to see later in the day is trying to achieve some pretty simple objectives from a company, and that is ultimately, as a shareholder, how are we going to create value for shareholders? And we have set the following objectives in our entire portfolio development, our entire portfolio swap out, the way in which we're trying to create a business that is easy to understand and investable in today's marketplace. And we recognize the Canadian E&P marketplace is challenged. For anybody in this room covering it, I'm sure it's complicated. But it's these basic principles, and that is we're going to generate meaningful year-over-year cash flow growth. We're targeting annual growth about 10 to 15%. You'll see numbers in the back as to where the portfolio goes. And that's driven by you have to be drilling the very best portfolio wells. So we have to have capital efficiency south of 20,000 a flowing barrel. And that means we're going to focus on primary and de-risk development. We have to continue to evolve our balance sheet. I think we're targeting EBITDA, debt to EBITDA of 1.5 over the next 2 to 3 years. So that's going to require discipline in our spend and how we're going to think about our balance sheet, which Dave talked about. But it's going to be through a very clear focus on the light oil side of the business. We intend to grow our Cardium light oil platform 30% over the next 3 years. And I would say that toggles probably between 20 and 50% based on very modest changes in pricing, because there's lots of ability to bring on bite-sized individual Cardium wells with very little cash out and a very fast payout profile. We're going to continue to rationalize our portfolio to reduce drag on that cash flow. Mark gave you an idea, obviously, from legacy. Legacy is a drag. It's $10 million a year. We need to think of continuing our portfolio, focusing on those barrels which are the most important. but also recognize that one of the legacies of the company is that we sit on 33 company-operated secondary assets, which give us a shallow decline base. So we're going to swap to light barrels, manage our shallow decline, but that will walk up to probably 25 to 35%, similar to what came in the room. But with that focus, we think that swap out will be valuable to shareholders. What that's going to mean in terms of our near-term focus is ensure the balance, focus on organic Cardium growth. We're going to manage the value of the other assets, and that's really by exit or commercialization. I apologize for the use of commercialization as a word. And in the end, to the extent we have proceeds from those, we'll look at whether we're going to swap it to organic growth or we'll look at returning capital to shareholders. But that'll be done only really as a sense of a use of proceeds. So if you look at the asset portfolio across the board, if you play out just the 2019 plan, which is the $120 million capital, the only importance on the left-hand side of this chart is that green gets bigger. So we'll have relatively the modest production in terms of 3 to 6%, but you'll notice the contribution from the Cardium grows up. It's actually up 10%, 2018 to 2019. And on capital allocation, even though we're trying to be very modest and manage to where you believe on diffs and strip in terms of the cash we can invest, the proportion of our overall capital, you'll notice, is remarkably greener between 2018 and 2019. So when I go around the portfolio, for us, Peace River, Alberta Viking are focused on manage the production and commercialize. And we are going to focus on aggregating in the Drayton Valley and central Alberta area, focused on the light. And we have, and you'll hear about the story later, a lot of infrastructure capacity as it relates to gas. And so where it is natural for us to aggregate and consolidate in Deep Basin, we'll be opportunistic there just to fill capacity we have. But our business is going to be swapping to lights. This is really a light oil play, and we intend to be the natural participant. And with that, Aaron.
Thank you, Dave. So for the next 45 minutes to about an hour, I'm going to walk you through in, I think, pretty strong detail why it is that we're so excited about the potential that we see in the Cardium. I know I've met several of you now, and I think that's been one of the themes, is a real hunger, a desire to see some of the details unpacked for you. Buckle up, here it is. I've been working on resource plays, frankly, from day one of my career. It's been about 20 years now. I've worked on 5 of them, from shallow gas, CBM, the Duvernay, the Montney, and the Cardium, in a variety of roles across them. And it's been a pretty interesting ride for me. But what I've noticed as I've worked through all 5 of those resource plays is that there are some fundamental pieces that you absolutely must have to have the economic success that you're looking for. Specifically, you need to have a very good land base. You want to make sure that that land base gives you plenty of room to run with a significant well inventory, and a well inventory that's going to deliver the economic results that you're looking for. It's an absolute necessity. Over the last few years, that 4th element has really come to light in terms of this processing capacity and egress. Ideally, there's lots of it. Ideally, you own it and control it. And you'll see those advantages brought to bear in our Cardium program as I walk you through it today. First, a bit of a macro view of the Cardium. As everybody will know in the room, as an asset, as a formation, it's seen development from the early 60s and on, and you can see really the production profile in the graph on the left. The spike that you see early on is, of course, the water flooding that occurred into that, and then the decline that followed was really observation of the fact that the vertical wells that were the technology at the time could only capture so much of the resource from the rock. As you get into 2008, 2009, 2010, you begin to see the potential for horizontal wells to, we put awaken the giant here, but really grow what at that time would have been looked at as a tired asset. Clearly, the Cardium has demonstrated that that is not the case, and that there is significant running room with a very small number of horizontal wells shown in the medium chart there, that this beast still has a lot of tricks up its sleeve, and it's going to continue to perform for the companies that are playing in it. Specifically to this wedge, if we were to zoom in on that, the story gets even more interesting, because over the last 4 or 5 years, you can see the trend here, and I've zoomed into the Willie Green area. The cumulative oil per well produced from those drills into Willie Green have improved year over year over year. There's really three elements to that improvement. Certainly well length is one of the key ones. As technology and confidence in that technology is improved, you've seen operators, including ourselves, extending the wells. And in fact, many of the wells that we have in our program go forward are 4,900-meter total depth wells. And when you consider that you're 2,000 meters deep or thereabouts, you're really pushing into that 2-mile range with these wells. And we've got a lot of confidence in how the completions and drilling technology is allowing us to produce from that entire lateral. The second element of that story is, of course, the completion and making sure that you've got every stage that you've put into the ground producing for you. And I think there's been a myriad of technologies brought to the front over the last few years that are allowing that to happen. And certainly we think we're right at the forefront in terms of that improvement. And the third element of that improvement that you see on that slide on the right, or the graph on the right, is simply better well targeting. I think you see us really with a clear understanding of the fairways. Today you will see very clear development plans year by year by year as we walk through these. I think our confidence and our understanding of the resource is really allowing us to push the envelope on what these wells can produce. So on that green diamond slide from a few minutes ago, I spoke to the land position. This is our land position. It is massive, bigger than 2 and 3 combined. It's immediately obvious here as you look at the map sheet. I've colored a few key competitors in a few colors there, not naming names, of course. But you can't just have the land. That land still has to have oil in it. And that chart on the bottom left here is really meant to convey the development maturity of these lands. If you think of the Cardium in general terms, where people are putting horizontal wells into it, 4 horizontals per section is a very typical well density. Some will go to 6 or 8, but for the sake of this review, I've capped it at 4 just to make the point. Where a DSU or a section does not have a horizontal in it, I'm showing that as this lighter shade of purple. Sections that do have horizontal, or quarter sections that do have horizontals in them, are shown in the darker color here. So it's really a qualitative or quantitative indicator of the maturity and the running room for potential horizontal wells that we have on our land base. But speaking about land base and simply applying 4 wells per section isn't good enough. So we need to talk about the rock and the development plans. So let's get at it. This is an attempt to speak to the rock quality. Everybody will stand in front of you, much like I'm doing right now, and tell you that their rock is the best. I want to show you why I feel that way. The squiggles on this map sheet are litho logs. They're analogous roughly to gamma ray logs. And in general terms, and the geologists in the room, please close your ears, yellow is sand, yellow is better on these logs. And what I'm looking to do with this comparison is really compare Ferrier, which has attracted a lot of attention over the last few years, Williston Green, which we hope is bringing a lot of attention through our activity, of course, and then the legacy Pembina assets that you see here further north. Just to give you a better context for the map sheet here, Ferrier shown in the dark green. Now these are all horizontals drilled into the Cardium, all time. But essentially this is 2009 or 2010 forward. So you're really looking at a decade of activity. Through this area here, you see a nice blocky sand at the top of the package. Thickness of the Cardium here is pretty comparable to what you see elsewhere. But the operators in this area are benefiting from thrust faulting that is adding some secondary perm to the resource. And you can see on a BOE basis, these wells, looking at the 12-month cum, and these charts are all 12-month cum per well, not normalized forward length or anything like that, it's just the per well. You can see that the Ferrier wells deserve a lot of the attention they're getting because the BOEs are so high. The challenge for Ferrier, in my opinion, is that the bulk of those BOEs are gas. In terms of when I look at investor reports for a variety of companies, I see a very high gas weighting for those type curves. And that has really manifested itself in this public data review. This is AccuMap data. This is a review that I'm sure you've done for yourselves from time to time. Stepping into Pembina now, so I'll go right to the northern end of the map sheet. We get into this lighter green shade that I hope you can see on your printouts or on the screens. You can see a much better weighting to the oil versus Ferrier, much less gas owing to more oil-prone reservoir and waterflood support, or nearby waterflood support for those, and a pretty decent 12-month cum from those Pembina assets, no doubt. One of the reasons why we're focused on Williston Green, of course, is a step up in reservoir deliverability as you come south into this medium shade of green here. And again, I'm showing all industry wells here, not just ourselves, in this green tone. Much like Pembina, much less gas-weighted, but still some very good deliverability, and in fact a step up in terms of total BOEs that you're seeing in Pembina. But the excitement that you've heard Dave and I speak about this morning really is about the performance of the purple columns on these charts. And it's quite subtle here because the development density isn't quite high for us in Crimson, but we see fairways extending basically a township and a half north of there. And what you're seeing here is wells that are competing with the best of the best on a BOE basis. But on an oil basis, they are right at the top, and it's really leading to the excitement that we have. So I've talked about the land. I've talked about the rock. Where I think I really wanted Obsidian to expand as we came into this presentation, or expand on how we've communicated with everybody, is with such a massive land base, with such remarkable potential. What is your development plan? Please be clear with us around how you're going to attack and develop these assets. That's what I'm trying to do now with the deck as I go forward from this slide for the next half hour or so. As we reviewed it, and the technical team did a phenomenal job really breaking this down into 4 discrete types of development modes as we attack the Cardium. I'll start with the bottom left, with this Crimson Lake, and this is, we use the term Crimson and Crimson Lake somewhat interchangeably, so apologies for the confusion. But again, and as I spoke to a few minutes ago, we're really looking at this banked oil opportunity with neighboring primary lands that are a very top quality reservoir. They've been delivering a very high rate of production for us and very consistent rates as well. On the few slides coming up, I'll show you some bookends. We've actually got a great well at the north and some great wells in the south, and we're just going right in between as we develop Crimson Lake. What you'll see on the maps that follow is this significant well inventory of 59 locations that exist after we complete this 15-well fast-track program, or this H2 program. So very considerable running room left to go in Crimson Lake. Very, very exciting for us. Coming over to East Crimson, geologically very similar, where we've got 3 cycles of the Cardium in Crimson Lake. We have 2 cycles of the Cardium in East Crimson. Here we've got water floods that have been, some have been quite successful and performed well. Where I'm really interested in are in the water floods that have not been as successful or as heavily developed. Really, as you consider water floods and you look at an AccuMap map, you'll notice the Cardium, top to bottom, can have 16 wells, 16 vertical wells in a section, or even down to 4. It's the sections of land that have very little vertical development that are the most intriguing to me, because it's a really good analog for its rock that was a little too tight for these vertical wells to drain, but horizontals are going to come in here and do a remarkable job of recovering the asset. Shifting to the top left now, into the West Pembina, this is really a Goldilocks scenario, as it were. So the conventional pool is right in the middle, and I'll speak to Central Pembina in a few moments. But this was a set of assets, most notably an Imperial Oil-held asset for many decades, that simply did not see a lot of love. And these are one of those assets that were drilled at 4 vertical wells per section. And so there's really an excellent opportunity here, I see, to ramp up our development, really turn that area or that unit into a primary development, and really extend our development much like we're doing in Crimson. It's very, very analogous. To give you a sense, where we see the first wells into one of the units has a 5% recovery factor. It's not a number that you would consider when you look at the decades of production that would have been capable out of that asset. So it's a phenomenal amount of running room. At 5%, you're really talking about a primary play at that point, and you'll see the development plan later this morning. Stepping into Central Pembina, the last of the 4 development fairways that I see. These are more of your targeting of what I'll call fences, or corner shooting your water flood and attacking line drive fairways within the water flood. These wells in general tend to have very good EURs. They tend to be a little on the lower side when it comes to IPs, but there's still significant potential there. Remember that this is, as I showed you on the previous slide, the thickest, highest quality cardium there is, so there is a definite prize to be had by attacking these fairways and doing the strong technical work to make sure that we can bring these wells as we promised. What I'm about to show you then for each of these assets, and I should quit saying about to and just show you, but what you'll notice on the 4 map sheets is very discreetly targeted sticks on a map. So what we didn't want to do is come today and say we've got X hundred locations of inventory. The locations that you'll see on these map sheets are specifically located relative to bubble mapping and reservoir modeling that we've got. They're also tiered in terms of time. So what I hope you'll take away out of this is that Obsidian has done a very good job of describing our development plans in a very thorough, thoughtful way. And I think you'll see some of the quality of the technical work just as you review the map sheets. The first example of that is Crimson Lake. So as I mentioned, and I'll just perhaps just point to the slide here, this area here is that primary fairway that we see outside or on the east side of the North Saskatchewan River. And we see the very similar results from these guys here, just on the west side of the North Saskatchewan River. The bank-to-oil opportunity that we see in Crimson Lake is largely a function of access constraints that withheld vertical development over the last several decades. Vertical wells, of course, are just that, vertical. And when you're facing not only the North Saskatchewan, but the banks around the North Saskatchewan, you quickly see on a map sheet that there's simply a large swath of land that the water flood was pushing up against but could not flow past, that generated this significant banked oil opportunity. And I feel that's a significant contributor to the performance of the wells here. On the other side, it's more of certainly a primary development, but a very high quality one. In terms of rate of return, these wells are actually fairly similar as you go across. The purple wells that you see here are either the last 7 wells from the earlier part of the program or this 15-well fast-track program. You'll notice that they're very tightly spaced in terms of we haven't stepped out 3 miles away or 6 miles away. We're doing this because it is the most efficient way to develop the resource in terms of a capital perspective. You can think of daisy chaining your pipelines, reusing frac water infrastructure, reusing roadways, and so on. You can only do this when you have significant confidence in the resource. And one of the things is this bookend that I'll highlight for you here is a pier well. We happen to be 40% in that well. It's, I believe, a 10 of 34 location that has very good oil rates and very good BOE rates as well. So it's really giving us confidence as we extend from our own results and walk in a very orderly, methodical fashion to the north end. And I think we're going to be very, very pleased with what we see here. So count sticks. You'll notice it ties very well to what we've got. I should notice, too, or highlight the color. So purple is the near term. The darker green would be a year out, lighter green, and then getting into the gray as being future development locations for us. The type curves, we've shown 2 different type curves for Crimson Lake. As a function is the mineral land configuration can have an impact on the well lengths that you choose. Our preference is to go to the 2-mile locations or about a 2,600 meter lateral that I've shown there in the darker tones. And where the land configuration doesn't allow it, we'll shorten the wells somewhat to that 2,200 meter length shown in the lighter green tones here. More details than you can shake a stick at with respect to the type curve and the economic results there. Hopefully that gives you a really good idea of how we see the world from a capital perspective and an economic perspective. I will highlight too on the bottom of the chart here, if we were to look at a Cardium development plan over the next several years, you can see that the darker shades here really occupy a very good portion of that timeline. What we're trying to convey is that for the next 3 years of Cardium activity, we see Crimson Lake as the primary focus of that activity. One of the reasons why I'm a big proponent of these longer and longer wells is because we're getting better and better at putting them down into the ground. This is a time depth chart. Many people will show it. The drillers love to use it. What I've done is I've gone from the green to the yellow to the blue to the purple in terms of time. And you'll notice 3 trends immediately come out. One is we're drilling longer laterals, as I just mentioned. 2, we're drilling those laterals faster and faster, it seems like, with every location we get to. That manifests itself on this chart as a steepening of the line. But there's also a significant reduction in non-productive or non-drilling time that can manifest itself as these little steps. Those are periods of time where, for whatever reason, commonly a bit trip, you've scrubbed a bit and you need to get a new one in the hole, you'll lose a day here or a day there. No more is time money than in drilling. And so anytime you can increase your rate of penetration, reduce the number of bit trips, and even these last few wells, drilled the entire lateral, and remember this is at a significant length, with one bit. So that is just phenomenal cost savings, and those are what I call sticky cost savings. So no matter what rig companies want to do with respect to day rates, they can't add a day back in because we've gotten better operationally at putting these wells down. So I'm immensely proud of this slide. It's pretty techy, but I'm very happy with what it tells me. So we've designed the well, but positioning the wells, spacing them, and putting the frac stages is, of course, another key element to designing your development program. What we've shown here is output from some reservoir modeling that we've done in a specific piece of land in our land base, but the themes apply on all of the Cardium lands that we have. We're looking at refining our inner lateral spacing, or the distance between these horizontal legs, to make sure that we're not putting them so close that they're overly competing for resource. I think anytime you've got 8, 10 wells per section in this type of rock, these wells are competing with each other, and that is significant potential for overcapitalization. So for us, looking at the rock, making sure that we are at the right spacing for our rock is a key element to our development planning. Specifically for us, it's in that 4 to 5 horizontals per section. Stage spacing is another key element of this, but you can imagine if the laterals are spaced apart because you have confidence in that rock to transmit oil to your well, you need not spend all that capital to really have 20-meter frac stage spacing in your wells. And you'll see other peers talk about that. I'll put it to you that I feel they're doing that because they need to. They need to create that permeability of the rock. As I've said in a few meetings, perhaps with a few of you, I'm not going to apologize for having sand or permeability in my well. We're using this as a key leverage for us to keep our costs down, but still maintain the well performance that I've spoken to on previous slides. With respect to lateral length, again, as we get confidence in the drilling and completions technologies, we continue to push this out right to the extent of the mineral land position. We do see a bit of a practical limit as you get beyond 2 miles. You begin to see your rate of penetration slow a bit, but again, this is a function of depth, so I wouldn't consider this to be a hard boundary, but it is something that is a very asset-to-asset specific type of a boundary that we'd have. Of course, you want to have these great wells, but doing them cheaply is the focus, and I'm a pretty cheap individual as it is. Well, I've shown here the capital with respect to the 2,200 meter type curve. I'm pleased to say that we've been able to make great progress, and we've been targeting a 10% reduction as we get into our 2019 program, and we're about halfway there. So the type curve capital costs that you've seen shown to you are really based on AFE estimates as we headed into the the Fast Track 15 well program. But what I've been able to, what the technical team and what the operations team has been able to do is really actively drive costs out of our business. I showed you that one photo before showing some of the logistic benefits that we've had. We're really chipping away and trying to get that last quarter mile or half mile of the wells for free. That's definitely been the challenge, and we're working hard to delivering that. Stepping now into East Crimson. And again, this immediately borders Crimson that we saw a few minutes ago. Very similar resource, 2 cycles of the Cardium instead of 3. There has been, similar to Crimson, some waterflood development here. But you can see that we're targeting with the wells in gray there, fairways of unswept resource in a slightly different way than you'd go at Crimson. So it's less of a primary development in East Crimson than you saw at Crimson proper. I'm going to skip ahead a couple slides here to show you why that is. So this map sheet is highlighting the recovery of oil on that map basis. Areas that have high recovery of oil, and we're not normalizing for thickness here, just in terms of recovery, I've shown in blue tones here. In a water flood, you can imagine those as swept. That's why we've chosen the colors that we have. Areas that don't have as high of recovery or significantly lower recovery are shown in the darker green tones. So I think it becomes immediately obvious, and this isn't the only analysis we do, of course. There's bubble mapping and reservoir modeling that goes into our location selection. But we found as we were prepping the slides for today that this demonstration really did a very good job of highlighting why we see these fairways, and Dave mentioned an outside-in approach. The no-flow boundaries that exist at the borders of these water floods have been something that industry have chased for some time. Commonly we call that corner shooting. But the realization has been that corner shooting ourselves is also an excellent opportunity. So we are targeting the wells within the units, but we're really doing the same thing that people have done to water floods, and I've worked on different plays and done the same thing myself and targeted these, and we're very, very excited at what these wells could do. I also want to note that we are not the only ones playing this game. We are not out on an island. These wells here, and we've shown the peak calendar day oil rates from these wells based on public data. We do not, this is not internal PVR data and time shifted and all the rest of it. This is AccuMap type data. These wells are targeting the very same type of play that we are. We haven't highlighted the lands or extended the mapping onto somebody else's interests, but these are unitized lands, wells going between verticals and injectors and delivering some pretty compelling oil rates there. As you step out and beyond and you get into some pockets where the rock quality is not quite as high, you see wells delivering good IPs based on very intensive fracs, but as you look 6 months into the producing history of these wells, you realize that there really is no replacement for rock quality. So I'd encourage you guys to take a look at those wells for yourself. So I'd highlight the well colors again. That really speaks to the pace of the timing of the development that we see in that Crimson East area. You can see the focus of the capital program. So we're really spending the next few years to work up on our inventory, refine and perfect our technical story, and then begin to move into this asset as the higher rate of return Crimson inventory is consumed. Okay, stepping into West Pembina now, so we've gone further to the northwest. I used the term Goldilocks earlier in the presentation. I just want to kind of highlight that now as we zoom in. So a lot of the West Pembina halo that you've seen, many of the notable peers in industry target, is this area out here. And in general terms, the further you're getting away from the central portions of the Cardium conventional pool, you're getting into more shales rich, more distal, as the geologists would say it, tighter rock. And so we feel like we sit in with our assets here in a very good position where we're not conventional, such to the point where the water floods have worked remarkably well, but we do see this as a step up in reservoir quality from the halo that peers have developed at 4 and 6 wells per section in this vicinity here. You'll notice the sticks really reflect a primary style development, and that's exactly what we have envisioned here. A few moments ago, I spoke to a very low recovery factor in this area, and right now we see it at around 5%. So very, very low recovery factor in that particular piece of the asset. A great opportunity, I think, for us to step into a Crimson-esque primary development opportunity. In general, West Pembina competes quite well with Crimson on an EUR basis, but does not quite have the very significant IP rates. Oil weighting we see is pretty similar to Crimson as well. Rate of return, these sit one step below Crimson, but compete very well. And so we'll continue to work the technical on this and build readiness to have a significant program in this area. The final of the 4 development quadrants, if you will, is the Central Pembina one. And I'll spend a bit of time on this because I want to really help people understand and characterize both the potential that we see and the results that we've had recently, because I think it's important to put some of them in context.
Hey, Aaron, sorry, maybe just pause. I think we're having some technical difficulties on the webcast. I just want to make sure that we get that figured out for 1 second.
Okay, so we're good to go? Okay. So what you can see in the location of the inventory within the Central Pembina assets is the wells, the sticks that have been plotted on here are really targeting on the southern end line drive, banks of oil that the line drive water flood has caused by virtue of how the flood fronts are moving. As you get into some of the northern assets there, you're still chasing water flooded assets, and again, these are very thick Cardium assets with a lot of oil in place. Different perspectives and different fairways based on differing configurations of the injectors and the patterns that have been in there for decades. PCU9 was mentioned earlier as part of the H1 2018 performance, and I wanted to give you some context on that. The wells today are producing 80 barrels, the four are producing on average 80 barrels of oil a day, and they've been flat for around the last 4, 5, 6 months. If somebody was to tell you that, I think you would run your models and say that's going to be a pretty decent well. I think the challenge for us in that development was the additional injector capital that was put around those wells to make them go. And I think making sure that our infrastructure in that area had the ability to handle all the water. So that 80 barrels a day of oil is at a 60% water cut. Again, drilling into a 60% water cut well when you know it's going to be there is not something that is of a concern. As any old water flood hand will tell you, the key to success in getting the most out of a water flood is making sure that your water handling is as efficient as it can be. So I think what you'll see as we get into the Central Pembina assets and begin to develop them is really a very robust look at the infrastructure that we've got, and perhaps a little bit more spread out across it and chasing the fences, as we've spoken about before, to really disseminate and distribute that emulsion production to surface to make sure that we can fit it into the existing infrastructure. Similarly, reusing existing pipelines and injectors and perhaps reactivating some as a way to really pull capital out of that development program and to really push the competitiveness of Central Pembina to bring it up to the other three quadrants of our development plan. As I mentioned, the very thick Cardium, the high-quality Cardium, is really driving very significant EURs from these wells. Because the deliverability is really a function of rock type, you're not, the IPs do not carry. It's typically the tighter rock that delivers the very good IPs, and then the EURs are not quite as high as this 280 MBOE that you see there. Development plan-wise, we're going to take our time here and do it right. We've got a significant amount of high deliverable, short cycle return opportunities in Crimson. That's where our focus is going to be, but that does not mean that this hits follow in terms of it from a technical perspective. We've got reservoir models that extend over 2 of the major units in the area, and we're going to continue to pursue and refine and understand the opportunity here and make sure it's as economic as we can make it. Capacity is a really key element to keeping your costs down as you work through your development plan. I've worked Sour Montney where egress has been just a fundamental concern. And I think in my time we were talking more about that and how we could get egress than we were talking about the resource itself. We don't have that problem here. We own, control, and operate the infrastructure for oil and gas to get it to market on pipe. I've shown 2 zoom-ins here of the Willie Green region and the Pembina region there. You can imagine Pembina having just the massive land base and the massive well count having an equally massive infrastructure on both emulsion and gas. It's up on the slide. In Willie Green, we have a significant amount of emulsion handling capacity and gas handling capacity as well. I expect that with very large programs, we'll have to do very minor tweaks to the emulsion handling side first. Adding treating capacity is trivial in cost as it reflects, in comparison to gas compression adds. So I'm feeling very good about our ability to very efficiently fill this capacity and move forward. So the last slide then is really the culmination of all these development plans that I've put forward to you over the last 45 minutes or so. The Cardium by itself, if you were to consider it a business and look at a field level NOI basis, is really a self-funded development. It can generate significant cash flow, $60 million a year on the price deck assumption, on the planning deck, and with even more upside as we get into the upside pricing deck that Dave walked you through a little bit earlier today. You can see all our detailed sticks on the map. As I've tried to highlight for you over the last hour or so, these are specific locations. This is not hand waving. This is not a four-well per section calculation. These are very specific, tangible locations with a very methodical and timed out approach to bring them forward. And with that, I'll open it up to questions then. I hope there are a few.
Just in kind of thinking about the last Analyst Day, so is the kind of the joint water flood primary program, is that done then, essentially? I mean, is there, in terms of your vertical or your water flood injection additions, that, you know, where does that fit in, or is that done?
I would not say it's done. I think what Crimson has done as an asset has really given us a very compelling primary development mode to get at. It is the highest rate of return in our portfolio. It is demanding capital come to it. Over time, as we exhaust that inventory in other areas, I think what you'll see from us is begin to step into these water flooded fairways. But again, remember, as Dave mentioned earlier, the recent activity in PCU 9 was really going at the heart of the asset. And I want to bring back the slide as I walk through Crimson East to really reinforce that point. You can see what going to the heart might do, and this is not PCU 9, so I don't mean to create confusion, but it is a water flood. You can see that recoveries internal or on the inside of this unit are the highest. I suspect you're going to see that on many of these older units, and so what you'll see from us is an approach to go outside in, really targeting these less swept or unswept fairways, and with confidence bringing that into the asset. The other change that I think you'll see as we approach these water flooded assets, as I mentioned a few minutes ago, is a very different approach to how we're capitalizing or managing the injection side of things. So there'll be a very strong focus on reusing existing vertical wells and reactivating, reusing existing pipelines. And so I would be very hesitant, I won't say never, but very hesitant to commit to new injector drills as an example, as a way, certainly in this pricing environment, to make sure that our capital efficiency is as strong as it can be. Hope that answers your question. Okay. Okay, very good.
I got one on the phone here, because I think we had obviously a lot of water flood discussion, so maybe talk about reserves in the Cardium in terms of how we're booked right now relative to the inventory you see.
Sure, great. And I apologize, Brad, I didn't highlight it on each of these development fairways. But I'll come to East Crimson makes for a good example here. What we've tried to do on the data blocks in the bottom left of each of these is really highlight the existing inventory that we have, but Sproul is our IQRE, or Independent Qualified Reserves Evaluator, and their perspective on it as well. And I think what I want you to take out of these is that the reserve evaluator is recognizing our development plan. They see the same potential that we do in terms of well performance and the amount. We just have simply not pushed them to book them fully. And I think that's something you'll see common throughout each of the four fairways. And I think that reviewing each of those slides with the numbers on those slides would probably give the question the best answer possible.
And the next one is just on costs within the Cardium. I know you spoke to Wilson Green being around $8. Pembina is obviously a little bit higher. How do you see op costs evolving over the next 3 years in Cardium?
So op costs are going to be a function, frankly, of the throughput that you have. And so I think what you'll see is further suppression of that $8 number in Crimson as we begin to really fully develop and keep those infrastructure pieces as full as we possibly can be. Other assets, I think they're in the 12, I shouldn't estimate now, but in that order of $12 to $14 as we get outside of Crimson and head into Pembina. I think you'll see those fall as well as we begin to add volumes, and so it'll track quite closely to total oil production.
This is Dave, I guess. I would say I do think because of the portfolio swap and obviously the focus on Wilson Green, and you saw certainly that's over the next several years, we do see a $1 and change evolution down on average operating costs for the company as we saw through water growth.
I'm not sure they turned your mic on, so maybe just repeat that.
I would just say, as another addition to that, I would say that swap between Pembina and Williston Green, Obviously, the focus is on Williston Green for the next 3 years of development. If you aggregate that across the whole portfolio, we do see, a $1 migration down of operating costs per barrel basis just because we're averaging on a lighten up and the highest margin version of the barrel.
Okay, thank you.
You're up.
What I'd like to do is take the next 10 minutes or so and walk you through how we see the rest of our assets. Certainly the Cardium is the company, but we want to make sure that everybody had a good understanding of what we were seeing in terms of activity and thoughts around these other assets as well. So I'll first start with what we call Deep Basin. This is really a stacked potential play with the Cardium. What may not make it out on the monitor, depending on how the colors are, is our Cardium land shown in the green shapes. And then we're showing it overlying here, even though the Manville is underneath, the orange lands here, which really reflect the Manville and even deeper stack that we've got. We've spoken at length in some of our press releases about some of the recent Manville wells in the Crimson area. Adding Manville wells to our Cardium development plan has really been a tremendous opportunistic way to develop these assets at a very low-cost manner. Typically, our wells are seismically delineated channels, so we've got a really good handle on where that reservoir is and isn't. But when you imagine if you have a pad site, and we actually have one of these envisioned in 2019, a pad site with 2 Cardium wells already slated for that location, adding to Manville to this comes at a tremendous cost advantage. You're not constructing for those 2 Manville wells, so take that right out of the equation. The pipelines are already sunk, so you don't need to burden your wells with that. The frac water is the same frac water. In fact, the stimulations are very, very similar. And so roadways, it just goes on and on and on. And so when you've got a C-ring set up for frac water and you just have to move right to the next well, you can, I think, immediately see some of the really strong synergies between the programs. And so that's why you've seen a lot of our activity really stay focused in around our Cardium activity as well. And I think that's something you'll see as we progress into other areas as well. It's constantly looking throughout the rest of the stack to make sure that we've targeted reservoirs that are very close vertically and aerially. This stack really highlights the breadth of this additional land position that we have in what we're calling Deep Basin. It isn't just the Falher and Notikewin, but it extends into the Rock Creek, and there's even Duvernay rights within the portfolio as well. And what we've done on each of these layers of the sandwich here is just highlighted lands that active peers in that particular horizon are working in. And what you'll see is that our land base is proximal to many of the recent activity that each of these players, and they may be different players, into each of these horizons are working. This becomes excellent currency for us as well in the event that we want to generate third-party revenue as people produce their wells into our lands, or our infrastructure, sorry. Perhaps they farm in on us and generate a royalty income for us and generate processing fees for us, or perhaps it's a swap. Could even go to asset sales as portions of this throughout time. So it really has been important currency for us, and we've really benefited from having this significant stack. The type curve is shown here. Again, these will vary as we get into different wells of different lengths and so on, but I think it's a very good indicator of what you can expect from us. Stepping now into prop. The prop asset is shown here, and it's a bit of a busy slide, but there's a lot of key elements that I want to draw your attention to. First is the top right, a very significant inventory number of just over 250 locations. They're blocked out here in the quarter section blockouts that you see there. Each of these we have internally tiered as well. So were capital come to the asset, we have an orderly step-out plan to work through that inventory. An important element, especially these days where margins are very tight, is I think the team has done an excellent job of scratching and clawing every dollar they can for every barrel that's sold, because we have access to the Rainbow pipeline on WCS pricing. We can put oil on rail and sell it that way, and about 20% of our production is on rail currently, or trucking it to any number of 10 terminals and blending it into the Peace Sour system and getting an uplift from that opportunity as well. contracts that we have for each of these types of arrangements are very flexible, and so we can move these around really in response to the pricing that any given month could present to us. And my last slide of the morning here is a bit of a focus on the Viking. The challenge with the Viking right now is with its 50-50 gas-oil weighting is it simply does not compete internally for capital with the Cardium. And so what you're looking at is a pretty contiguous land base here, an asset that has great torque as gas prices improve, and I hope the last few days are an indication that it's going to continue. Access and ownership and control over 2 gas plants in the area. So it's, I think, a really good company in a box, as it were, type of an asset. But again, it's the competitiveness internally here that has been the challenge for our Viking.
Thank you, Aaron. So I'm going to come back to a bit where I opened right after I finished the view of the 2019 to what is the strategy for the company and how does the combination of the development that Aaron's played out not only this year but the next several years forward, what does that mean for us in terms of a business? If you go back to those priorities of generating cash flow, focusing on our balance sheet and maintaining it in a healthy form, and really thinking about how we're going to grow the light business, what really happens over time? We are focused on generating year-over-year cash flow growth. And so if you look at 2019, we'll be sitting in the range of sort of bounded between 100 and kind of 150, and you can imagine up to 160 million depending upon strip of funds flow for next year. We do see, as you continue to see, that has about a half year of evolution of the existing hedge book. The change of that hedge book as well as the growth that's in that business, we see that evolving up into the range of kind of 180 to 250, 60 million for 2020 and 2021, and that's all on 100% reinvestment rate. So focused on continued strip and improved pricing, balancing that cash to cash flow, but we see that engine for swapping out a low efficient barrel with a best barrel with a $20 to $30 net margin naturally creates on your base book, even though your company is growing at a size that is 10%. When you're growing the underlying business higher than that and those barrels are worth more, the growth and spread generates cash year over year. What does that mean in terms of our development profile and what we focus on? So when you take the all-in, so there's a mix of a deep basin, and I think when Aaron was going through, you'll show about 9,500 a BOE on a capital efficiency basis. Our opti is spend, but this is doing work on wells that have already been drilled. That's some of the best capital, and we'll always do recompletions and simple work. But the combination of our Cardium driving a primary program at 17,000 a barrel gives us, even when you pay for the entire corporate capital, all dollars in, you're still sitting at 20,000 a flowing barrel, which we believe makes us competitive with anybody in the business, and it's all about driving near-term cash. So what does that mean in terms of evolving the business over time? And a question was asked a little bit about our overall corporate margins. When you think about that corporate margin, both OPEX and then the cost to run the business from G&A, paying for the building, thinking about our interest expense, that number right now all in, you can look at it, kind of sits right around $8. We do see the natural swapping of low margin barrels for high barrels, walking our overall portfolio on a full cost basis up into the $15 range, which we think, again, over the next 3 years, that's a significant evolution of our ability to generate cash on the same barrel being produced. So that swap, and this is on the 120 million case, you can imagine the more we can accelerate or bring forward these light barrels and a place where we can get them efficiently online, it just creates a real aggregation where the idea of driving the business to an all-in full cash cycle of north of $20, we think has real potential to return value to shareholders, both in terms of the price itself and how people think about the multiples. As we evolve our business down, we are going to continue to focus on our senior debt. We're sitting at about 2.7 right now. Obviously, with light oil diffs, we're continually focusing on how we want to spend our money, being very methodical on individually walking each well as we go. It's important to focus on diffs, but also these individual barrels, every barrel we bring on improves the EBITDA forward for the barrel that sits with it. So that balance of taking very cautious steps and bringing them on, that's why we think we have an evolution down to 1.5, and that's the target of the business. Obviously, we're drawn on a credit facility. We've got about 61% of our debt comes to our facility. We do have some senior notes, about 15%, but we have plenty of headroom as it relates to the unutilized facility. So what's thinking about is we're going to evolve to the light barrel in a way that is methodical and within our debt. So when you think about for simplify and grow our light oil business, what does that mean? As I described, the corporate business itself, if you look at the overall business, we're focusing being between 25 and 35%. There is a cost to moving to primary. If we were to do all inside low time horizon water flood development, we could ultimately grow lots of value over time, but the cash cycles would be too long for you to really see that growth. But by the way, it's a 15 to 18% decline business, so it gives us lots of annuity that we can clip coupons on year after year on maintaining that business. So if you set aside that coupon clipping business and you drive very crisp, light barrel primary development on top of it, you get a very nice corporate profile because we'll step up in terms of improved price. This swap out may hold the flat business, but our Cardium business will climb from about 70 to 80% of the portfolio even over the next 2 years. This is where the engine of cash is coming from, and this is where the focus of the business sits. So what does that mean when you just think about Obsidian? This is really my last wrap slide, and then we'll go to questions. When you think about who we are, you've heard a story today, and we talk about it. We are the largest Cardium acreage holder, bigger than number 2 and 3 combined, nearly the number 2 and 3 and 4 combined in terms of the acreage we have. But not only that, we're sitting in low double digits in terms of where people have put horizontals on the acreage we have. So it is a large primary development opportunity. But the thing is, you still have to drill good wells. So we've been evolving to focusing on driving costs out of the individual wells, manufacturing them, and making sure we're drilling them as fast as we can and as expensively as we can. We think that evolution is a real catalyst and has brought the whole Cardium play into the fore. But it doesn't matter what you have in terms of well inventory if you can't process it. Even when it relates to the deep basin and relates to our Cardium, the fact that we have big infrastructure and kit and 10,000 barrels or 12,000 barrels of emulsion capacity and 70 million of processing capacity of the gas, that headroom, you can't go repeat that. We have the advantage of that, and that allows us to drill very high margin wells because we're coming into stuff that already exists. So that combination is unique, and the fact that we're not drilling 30 million, 10 to 30 million wells, so each well takes a long time to cash. These are 3.5 million a pop. So we have lots of flexibility on turning them off and on to manage our cash so we can manage our balance sheet and manage our growth effectively. That combination of lots of flexibility, lots of headroom, the wells themselves are quite good, and we have a ton of them, we think brings us to very reasonable cash flow growth, and I showed you a number that was closer to 30%, but our target is to be at least 10 to 15% cash flow CAGR year over year, and in a way that's going to focus and drive us to be a conventional light oil champion and be the simplest story on the street. That's where we are. I'm open for questions.
So given that, in the asset part of the discussion, there wasn't a whole lot of wells allocated for Central Pembina, maybe a few option wells in West Pembina over the next 2 to 3 years. What's your feeling in terms of, is that an asset you would be willing to divest at some point, and where does that fit in the portfolio long term?
I would say it's a balance of as price improves, it actually is a nice cash flow engine. I think for us, it's not going to drive a lot of capital in the near term. So I think we would always look at that trade-off of, you get the annuity and the forward value, so that there has to be fair value for that forward annuity. Because for us, any kind of movement in price, and $1 at par is $7 million of funds flow. That business is shallow decline, plays out for years. We have inventory developed there, so it would always be, would we get fair value for that tail? We're always looking at the right opportunity to commercialize, but it's really going to be about swapping those long-durated, high-margin values years out for the right opportunity to do primary now.
I'll maybe add to that, that those profiles were on kind of the strip case right now. I think if we had a better pricing environment, you might see us actually get to some of those wells in the next 3 years. We'd be just drilling a lot more.
Jason Frew with Credit Suisse. There's been a fair bit of change with the company over the years, and I'm just thinking about the organizational strength to manage the program and whether you feel like you're fully equipped organizationally at this point. Thanks.
I think the more that you the more that you apply focus to what you want to do, the easier it is to maintain that organizational strength. So it is, as we've sort of rationalized how the portfolio focused on the engineering spend and the capital spend and the development, frankly, infrastructure, field assets. You're right. If you go back 3 years ago, 4 years ago, we were in 15 operating fields. We have 4. We were spending activity across even broader scale, 3,000 employees to a couple hundred. But we are very focused now on the technical evolution of the Cardium play. We intend to be the most disciplined and most informed developer of that play, both in the halo and the core. I think we have the very best people to do that. So from an organizational standpoint, that rationalization and drop to what we intend to be the very best at makes all those things very easy to do. Just apply focus.
Just a couple via webcast. This one's probably for Aaron, but discussing inventory, last Analyst Day, we put out 250 Wilson Green locations. We're at about the 200 mark now. How would you compare readiness and the quality of those locations a year ago to now?
Thanks. Good question. I think what I tried to stress over the slides that I presented this morning was that each one of these locations has been really technically vetted. I think I have a very high confidence in the detail and the inventory that we've presented this morning. One element to it as well is that as you extend from 1 to 1.5 to 2 mile wells, you need fewer of those 2 mile wells. And so what does have a suppressing effect on the total well counts in your inventories. So I think it's a combination of those two factors that are driving it. But yeah, I think the confidence in that resource and our development out there is as steady as ever. So.
Okay.